Welcome to TheoTrade. This is Don Kaufman. Here we are doing the weekend update on a Friday afternoon. It is August 12th, 2016. Let's get to it here. A little quick week in review, then we'll move forward, of course, to next week. The only way to describe what we saw this week is absolutely nothing, or, well, my personal favorite, massively unchanged. The S&P, and here we are again, about 6 minutes to go to the close on this Friday afternoon. I got to freeze the screen for just a second to just exploit, if you will, the nothingness. By the way, freezing the screen wouldn't really do anything because the market's frozen as it is. This is where the SPX currently is trading, which is 2183. So why do I mention that? Because I'll have a little bit of fun with this. But if you take a look at the S&Ps now, bear with me for a second. Look at the date right there. That's the last weekend's closing price. So that's just a screenshot for the most part taken on, of course, last Sunday. Where was the S&P? Well, we were at 2182, and now we're at 2183. So, ladies and gentlemen, what have we accomplished this week? Absolutely nothing. Oh, so exciting. But got a couple of trades in store for you. One of the things that you want to consider right now, again, the S&Ps aren't moving, okay? Volatility, and when you talk about volatility, everybody likes to reference the VIX over here. The VIX is down to 1150. I've seen it lower. You've likely seen it lower, but neither here nor there, because the VIX, once again, the VIX is 30 days out. Like, it's worried about options out in this range, 30, 34 days out. The issue that we have that are much more traders is that we're not necessarily worried about 30 days out. I don't know about you, but I'm worried about, I don't know, what is this next week going to look like? And lo and behold, you're looking at like 7 vol, 8.94 vol, even 12 days out, 8.85 vol. That screams to be, number one, I'm not selling nothing in no way, shape, or form in terms of selling premium. I don't care if the market didn't move anywhere this week. It's a setup for failure. You sell premium consistently in a low volatility market. It's only going to take 1 week. The market will make a big move and you get absolutely smoked. Okay, we've all seen that movie before if you've traded a little bit. So I want to get net long volatility. I'm going to show you a trade for that here momentarily. But again, just to back away and to consider how low the volatility is. Okay, again, 8%. This is like in the next 12 days. This is like saying the VIX was at 8, which it's never, ever been that low. But the next 12 days, the options are pricing the volatility in the 8 handle, which again, it's some unprecedented low volatility. Now, there are a couple of signs that volatility could be emerging. All right. Number one, and then going into this next week over here, number one, and I try to be as objective as I possibly can. The volatility, again, in the bonds is ever increasing. Died out a little bit. Now, we've had, again, a very tight range in the bonds, but we're still getting rather wild movement on a day-to-day basis. Need I remind everyone, again, if you're not comfortable with the ZB, you can always look at the TLT. And I reminded you last weekend of this. I'll remind you again. The volatility of the bond market today is higher than it is the stock market. Unusual, again, to say the least. So we're in this period of, it's unprecedented stimulus. I mean, that's the name of the game over here. Right now, we're massively unchanged, but the bonds are starting to move in a pretty radical fashion. The volatility has picked up in there quite considerably. Interestingly to me, you got the bonds rocking today. I mean, they were moving today, even the notes. Okay, and they did some decent volume out there, about 1.1 million contracts in the 10-year futures. Usually when you get the notes up, the bonds up, it has an impact to the financials. What do we get today? Nothing. It's like the financials were locked in the mud. So again, the bonds showing some resilience Okay, I think if the bonds this next week can crack into the 175 handle, look for it. Back up here to the 175 handle, which is, not too far from where they are. It's exactly a 2-point move from where we currently are. We had almost a 2-point range today, actually over a 2-point range today. But to the 175 handle, things are going to get real interesting in the broader market. Another area that I've been watching, and it's kind of at a huge inflection point. I'm watching the VVIX again all throughout the course of the week because, again, kind of inexplicably, the VVIX is getting lit. And that basically, I'll give you a quick synopsis of what that kind of means. Number one, what the heck is the VVIX? It's the volatility of the volatility index. What it really measures, it measures, the option sensitivity, if you will, on the VIX itself. It's like a measurement of implied volatility on the VIX. So for the most part, if you're looking at the VVIX, the VVIX is kind of measuring VIX options. So the VIX measures what? Options premium in the SPX. The VVIX measures options premium in the VIX. It's kind of a wild child product. But we had this, there's the bell, the week is over, and absolutely, what? Nothing happened. Oh, it was exciting. We had 3 days this past week where the VVIX really got lit up. And what that means, when I say lit up, I mean they're bidding it up. In no uncertain terms, that is traders coming in and buying VIX volatility. It's the only way it gets, that high. Now, the 95 level in the VVIX starts to get me a little bit concerned. The irony is it closed just a hair under 95 on this Friday afternoon. Again, to be considered over here, we've got bonds starting to rock a little bit. All right, they're right at that kind of inflection point. They really start to break above 173, and we could have some risk on our hands coming into the S&Ps. At the same time, we've got the VVIX getting bid up. And again, all it means, somebody somewhere apparently wants to get long volatility. So I can't disagree with that. So what I'm going to do is I'm just going to build a trade to get long volatility. Now, the trade I'm about to display is a relatively experienced trade. I already set it up in the thinkorswim Analyze tab. Bear with me here for a moment. It's just a trade in the spiders. What I've done in the spiders is I've actually created a diagonal. Now, I've displayed this a number of times in the TheoTrade chat room, but I figured I'd go over it here on one of these kind of weekend updates over here where I'm selling the 209 puts. I sell the 209 puts. Now that's for what? The 2nd of September. They expire the 2nd of September. What is that? About 20 some days out? Let's take a look. There it is, 21 days out. Then I'm simultaneously buying, the NOVs. That's the NOV 18. That's the standardized expirations, buying the 203s. Now, one of the first things you have to notice in here, it's a diagonal. What's a diagonal mean? For the most part, what this trade breaks down to is there is a vertical spread embedded in here. And what a vertical spread is, well, I'm selling, these 209s. So I'm short these and I'm long these. What's the difference of the spread? It's about $6. So could I lose $6 in this trade? Yes, you can lose $6. Plus, you paid almost $2 for the spread. You could lose as much as $8 in this trade. You're like, oh no, man, that's a heavy risk trade. Come on, Don, you could lose $8. Yes, I figured that out. But the trade has a monster long volatility component. For just 10 lovely contracts, you get 208 Vega. You're like, what is Vega? That's your sensitivity to changes in implied volatility. Now, bear with me. Here I am, buying the 203 puts, selling the 209 puts. Let's say, for example, on Monday, the markets just fell out of bed. Let's say the markets totally fell out of bed. And what I can do, and I am showing you a little bit of this on thinkorswim, but what I can do is I can adjust the markets. I can say, here are the markets right now at 218.48. That's where they actually are. But I can take the market and I say, what if it went down $10? I just adjusted the market. I adjusted the market down $10. So this is where the market was. This is where the market currently is. Right? If it's adjusted down $10, went from like 218 all the way down right there to what? 208.48. Now, bear with me. The market goes down. You're like, what? You're only going to make $27. Well, that's today. What would it look like on Monday? Well, I can fast forward the date to Monday. Oh, I would make $122. You're like, that's not very good. Yes, but you're forgetting a huge component. If the market completely tanks, what happens to volatility? If the market tanked 10 points over the weekend, the volatility, okay, probably get bumped up. I don't know. Let's be conservative. Let's say 8 points, 8%. That trade makes almost $2,000. Right? Now you're paying attention, aren't you? And that's conservative. I think volatility could probably do what? 10%, maybe even a 12% bump in volatility. Okay? So the market could crash, the market can burn, and the volatility, the bump up in volatility, well, this trade's extremely sensitive to changes in implied volatility. That's the kind of trades that you have to consider right now. You know, everybody's worried about, oh, but it has risk. Yeah, it has risk. It's a diagonal. What happens if the market didn't move down 10? Let's say the market really tanked on us. Let's say the market went down, I don't know, $15. Okay? You got to go through what-if scenarios. You want to survive? You're going to go through what-if scenarios. The market moves down $15 in the spiders. Do you realize that's a 150-point move in the SPX? So we move down the market $15. Yeah, where does volatility go? I don't know. Let's say volatility then is up. Let's be conservative again, 12%. So I bump volatility up by 12%. The trade is still profitable by $2,000. You can move the market down 20 points. It's still going to be profitable. It's hard to lose the full $6, but you can do it. I've seen it before. Anyway, this trade, the reason it's experience is because you're going to have to roll these 209 puts. You're going to have to buy those back and eventually sell other puts and buy those back and sell other puts. There are opportunities to make a lot more than $2,000 in a trade like this, okay, where you can go out there and you can take these SEP 2s that I sold. Eventually you can buy them back, sell the SEP 9s, buy them back, sell what? The SEP 16s, buy them back, sell the SEP 42s, and again and again and again and again. And every time you roll, you'd be decreasing your risk on this diagonal spread. Think about it. Again, the whole key over here right now, this isn't about being right or wrong. Okay, let me tell you about a marketplace that doesn't move. We are just getting coiled up, right? Markets, they're not moving. I'm sure that everybody's, suggesting it's the summer doldrums. Well, I've been trading, okay, since the late 90s. I remember some boring years. I remember some spectacular years in the summer. August, though, okay, typically is not that boring. Historically speaking, the most volatile month in the markets, no, it's not October. Everybody thinks it's October. Why? Because the crashes, of course, happened in October. Statistically speaking, the most volatile month in the market, September. Well, if we know, historically speaking, the most volatile month is September, why not get long volatility in August? With that, I want to thank everybody for joining us here at TheoTrade. Enjoy your summer weekend because the volatility, it will come back. All right? We're not going to continue to be massively unchanged forever. With that, again, enjoy the weekend. Have a great time. See everybody Monday morning here in the TheoTrade chat room. Bye-bye.